Hello and welcome to this Monday's weekly market briefing. We've got lots to talk about, but firstly, Biden's economic rating with voters flatlines despite improving outlook, as well as that Europe faces a competitiveness crisis as the US widens productivity gap, as well as that hedge funds now threaten to pull Indian investments due to regulatory crackdown. We've got lots to talk about on the charts also, where lots happening on the economic calendar, but we'll come to that near the end, so make sure you stay around so you can see that. Before we get straight into it though, make sure to subscribe. The first article to talk about is on the topic of Biden and the US economy. Now, according to recent polls, Americans are growing increasingly happy with the economy. Despite this, citizens seem very reluctant to give President Joe Biden any credit for the improvements. Now, obviously, we've been talking about the US economy a lot recently, and we've also been talking about US politics a lot. The reasons why, obviously, the US economy has experienced, great ups and downs over the past few years. Not only have we had the COVID lockdowns, which affected the US economy greatly, but then, of course, we saw the political leadership of the US economy switch over to, Trump and to Biden, sorry. And then with that, we also saw the Fed begin rising interest rates as we did start to see inflation skyrocket in 2022 going into 2023. Now in 2024, though, we've seen inflation on the decline, as well as that we've seen, interest rates starting to be discussed about actually, reducing those interest rates, cutting those interest rates. And that's kind of been the key topic of discussion with the Fed and other central banks within the advanced economies of the world. So that's why, the US economy has been so interesting because not only have we had all of those kind of features and kind of interesting aspects to the US economy to talk about, but also, of course, the US economy has presented growth not seen across anywhere else on the globe, basically for advanced economies. And so, the US has really stood out. But interestingly, despite that, Biden's economic ratings have remained low. We've spoken about this many, many times. And this is largely because ultimately, US consumers did experience those high periods of inflation in 2022 and 2023 under Biden's leadership. And that's why I believe most voters are still not happy with the way that Biden has handled the economy, because to most voters, they're going to the shops or they're going to the gas station in America, and they're seeing the prices higher than usual, and they're looking back at periods before Biden, and they're comparing those prices to what they're experiencing now. And so even if we do see inflation come down, and even if we do see oil prices come down and that kind of thing, and growth continue higher, ultimately, what are voters feeling? They're still feeling the effects of those higher levels of inflation, and that's still going to be fresh in their mind going into the presidential election of 2024. So that's why I think it's going to be very hard for Biden to actually kind of clear his name on the kind of economic record, despite maybe his actually quite good performance in comparison to other nations, as we'll talk about in the second article, where we do talk about the US in comparison to Europe and the Eurozone and the UK's economy, and the kind of comparisons between productivity, with the US actually coming out of the COVID lockdowns very well, in comparison to most other nations, economic wise, and with the economic policies passed by Biden, it seems like investment has stayed high within the US, which can't be said for the same across the pond. So this is definitely a very important article to understand. And since we are going into now this election period where we do now know that Donald Trump will be the person facing Biden, understanding what Biden's messages will be in relation to the economy is extremely important to understand, whether if he gets re-elected, how the economy might do, how markets might perceive that. But also I think it's important just understand how Biden has already done, so that we can kind of better understand actually, what will be the results should he become president once again, or be just re-elected. So yeah, very important to talk about, and definitely something to keep your eyes on. Now, this comes in the lead up for this year's presidential election where he faces off Trump, just as we noted. The polls have shown recently that nearly half of all US voters are able to meet expenses with little left over, with this comparing to a figure of only 43% of voters back in November 2023. So this shows an improvement in the way that, general citizens of the US voters are experiencing, Biden's kind of economic leadership, and it does show that most voters are kind of doing better than maybe they were last year. That said, as we'll get into, it doesn't seem like this is actually presenting a more positive image of Biden. Now, the figure of those describing economic conditions of good or better also rose from 21% to 30%, so positive figures for the US economy outlook. Now, despite this changing economic outlook, Biden's approval rating in regards to his handling of the economy did not change, with and increased the number of those disapproving of his handling to 59%. So we've actually seen that worsening of his what US voters are actually perceiving Biden's leadership as in regards to the economy. Now, this paints a worrying picture for Biden as he heads into the 2024 election period, as he hoped to run his campaign in part based on his economic performance as president. The US experienced economic growth which was the strongest of any large advanced economies last year, with inflation also falling faster than most. Last week's NFP figure also showed that another 275,000 jobs had been added, and that's the NFP figure, of course, that we were talking about a lot in the lead up to that figure being released last week. According to polls, economic issues are a key item on voters' agendas, with inflation being the greatest stress of 80% of voters still. So, the economic kind of messages that we're getting from, data and that kind of thing will definitely be heavily playing into the way that US voters do vote in this presidential election, and it does mean that Biden's and Trump's economic policy will be a very important aspect of their campaign to listen out for and look out for. I mean, we've already spoken recently about Biden's kind of economic plans. We spoke about that last week. We're yet to hear too much from Trump, but definitely things can evolve as we do get closer to the election date. That's all to talk about in this article, though. Next article to talk about is in regards to Europe and their competitiveness crisis. Now, the EU is now beginning to worry whether Europe is now facing a competitiveness crisis. This comes as the US has further widened its productivity lead over Europe. Now, we talk about the Eurozone, we talk about the UK a lot, and this is because, of course, they're the two other really key Western advanced economies that we compare to the US and that kind of thing. And here we are kind of talking about an article which really does compare, the two sides across the pond. Whilst, the UK and the Eurozone are separate, especially following Brexit, ultimately they kind of often do fall into that same category just based on being in the same continent, of course. Now, competitiveness, well, this is kind of, an economic concept which, of course, has lots of relevance in the modern day, and has seen great change, I guess, over the recent decades. With following the 2008 financial crisis, we did see a massive kind of stall in competitiveness for both the Eurozone and UK. Meanwhile, we've actually seen the US kind of continue their competitiveness kind of growth, basically. We've seen them become more competitive, we've seen them become more productive, is probably the better word to use rather than competitiveness, sorry. But ultimately, yes, the US has kind of improved its productivity since 2008, whereas, the UK and Eurozone have kind of halted. Now, as we'll get into this article, there's numerous reasons for this, but what I think is going to also be important to kind of remember here is, we're always kind of talking about inflation, unemployment, and especially what, interest rates are and that kind of thing. And, with so much data kind of being spoken about, we're always kind of talking about those kind of figures. It's easy to forget the more longer term picture of these different economies, and what, all these kind of different key economic aspects of different economies do mean for the future of growth and for the future of investment into those respective economies and nations. So, when we are talking about a competitiveness crisis, whilst this might not be the, go-to trading fundamental piece of news, which will affect, whether the dollar goes up or down, or whether, we do see the Euro USD sell off, or that, that kind of thing. Ultimately, when we are looking at competitiveness, we are kind of looking at a more longer term picture, and this kind of news will spark certain governments, as we'll get into launching new policies, into maybe increasing investment into different areas, and that's what this kind of news is really useful for gaining an insight into, as we might read this, and then we might see in 3 months the UK or Eurozone introduce a new investment scheme into the public or private sector. So that's why this is so important to understand, is it gives us that better longer term picture of these different economies. Now, with recent fears triggering policymakers to call for private and public investment, recent data showed that the Eurozone productivity has fallen from 1.2% has fallen 1.2% in Q4 of 2024. So 2023, pardon me. So we've seen a decline in productivity, which is very significant indeed. Meanwhile, in the US, productivity rose 2.6% in the same period. This reflects the trend of the US having more than double the growth of the Eurozone and UK over the last 20 years. As for the reasons of such growth, it seems that the US is growing faster as a result of a younger population, which is growing more rapidly and working longer hours. This is now seriously worrying policymakers, who worry that this is becoming a reflection of a lack of investment into private and public sector. Productivity in the US non-farm business sector since 2019 has grown more than 6%. Meanwhile, in the UK and Eurozone, they've only seen a growth of 1% over the same period. Europe is far more vulnerable to market shocks like in 2008 and 2020 than the US, which explains this stunt in productivity. So, when we do have such a fractured region economically, because they're all different nations rather than the US, it being a nation full of states, we are kind of going to see, worse effects from these economic shocks like COVID, like the financial crisis in 2008 and that kind of thing, which does stunt productivity growth. So that's something that's very important to know, and an article which is important to keep on your mind. That's all to talk about in this article, though. Next article to talk about is on the topic of hedge funds in relation to investment into India. Now, hedge funds are now threatening to pull investments from India. This comes following new rules introduced in response to last year's short seller attack on Adani, which is one of the country's biggest companies. The rules being introduced by the Indian markets regulator will force hedge funds betting on Indian stocks to reveal all their end investors, which funds say will create severe practical difficulties. Numerous large investment banks have already wrote a letter to the regulator warning that there will be a large material legal and regulatory reasons for why it would be very difficult to supply investors' information to the regulator. The regulator has, however, clarified carve-outs for many of the funds and the banks, so that it would be less likely that clients would be caught out by the rules. Hedge funds still remain fearful that the regulations, however, will still require foreign investors with more than $3 billion worth of assets in the Indian market to disclose lots of minute details. The rules are reportedly a part of a drive by SEBI, which is the market regulator, to better understand the ultimate investors buying Indian stocks. And some are even saying this is in part due to the fact that India is worried about neighboring nations such as China and what kind of investments they're making into the Indian economy, and that's kind of what they want to track and keep an eye on. So an interesting article nonetheless, and something that's more interesting and less common that we might talk about something like this, but I think is still very important to note when we're looking at the global scale of investments and where hedge funds are kind of having issues and that kind of thing. So, important article to note nonetheless. That's all to talk about in the articles, though. Next to talk about, of course, is the charts, where we do have quite a bit to note going into the new week. Now, firstly, we are, of course, on US indices and the US 30 to be more specific. Now, we're seeing some very interesting price action play out, especially considering, the kind of data that we did get last week, with, last week's data obviously ending off on a high note, basically, with the US NFP figure coming out, as well as their unemployment rate figure. So with the NFP figure, we did get a figure coming in higher than forecasts. So we did see 275,000 jobs added to payroll, in comparison to forecasts, I believe, of 200,000. That said, the unemployment rate did go higher, from 3.7%, which was the forecast, to 3.9%. So a very interesting image presented by last week's figures. And as one would expect during that kind of period, we did see some volatility kind of arise from that, with price spiking to the upside and then downside. Interestingly, though, price did interact with this kind of trend line once again. So last week we were kind of repeatedly noting how price had broken below, on this kind of bearish momentum. We did see price break below this trend line that was acting as a kind of line of support for price, and we were kind of noting how this was denoting kind of some more bearish action and movement for the US 30 for the future. And we did see price kind of come up and then retest that trend line before selling off once again. But then we saw price come up the second time and test that, and now we've seen price test it a third time last Friday. So 3 times now price has interacted with that trend line, acting as resistance. So I think it's a very important line to note at the moment. Interestingly, though, price has now interacted kind of with that 78.60 Fibonacci level. So that's something to note, of course. What will be important to see, though, whether we do see now a continuation to the downside, whether we do see this kind of bearish momentum that we did see start maybe the end of Feb continue now going into the rest of March. So as we've noted here with this trend line, price has neared or even tapped last week this now bearish trend line that we're seeing form to the downside. So that's a very interesting kind of piece of price action to note. And so going into this week on Monday, it will be interesting to see whether price will break above this line or react to it in a bearish manner. So that's the area to note for sure. Next to talk about, of course, is the dollar, which as a result of the NFP figure last week, saw a great deal of volatility and actually saw price break further to the downside. So, on Thursday last week, on Friday's morning market briefing, we did note this kind of liquidity zone as the bottom of the market, or at least I said, it was likely that price had been brought down to this level in the lead up to the NFP figure to kind of get those bullish orders in and basically prepare for the NFP figure to be released. As a result of the NFP figure, though, we did see a move to the downside, or at least a spike to the downside, and price kind of ended up in the same area as before the NFP figure. So not too much volatility actually to note on the dollar as a result of the NFP figure. That could largely be because we got kind of some contradictory data within the NFP figures. We did get we did get more level. A higher rate of unemployment than we were previously expecting. That said, we added more jobs to payroll than previously expected as well. So, I think that's definitely affected markets and led markets to kind of not move either to the upside or downside. But that volatility did allow price to break lower than this liquidity zone. So that's something to note, definitely. What will be interesting to see though now is whether, because we're in this liquidity zone, whether we can find some bullish momentum to the upside now. If we do move to the upside though, I think, we definitely should have a fib drawn just so that we're kind of prepared for any continuation moves to the downside. So that's something that's important to note. But lots of opportunities probably to shape up this week to look out for. That's all to talk about in the dollar though. Euro USD is next to talk about, which of course, is just mirroring the inverse of the dollar at the moment. So we did see that spike to the upside, but price did end up around the same area as before the NFP figure. So like we saw in the dollar. But yeah, definitely some opportunities on the euro this week as well. We're kind of getting a small bearish divergence as well on the 4-hourly that maybe you could note. But price, like on the dollar, is sitting around that key area of liquidity. So keep your eyes on that. Next talk about though is pound yen, which is once again acting in a very interesting manner, reacting to these areas of liquidity and Fibonacci levels quite cleanly. So we are now kind of seeing this trend to the downside seemingly, with price coming up and reacting to that 50% Fibonacci retracement level last Thursday, and we were kind of expecting a sell-off from that area as a result. But last Friday, whilst we did find some bearish momentum, price did not end up breaking below that lower low. So, maybe we're not actually in this period of bearish momentum for pound, and we could definitely now just continue back to the upside. So, keep your eyes on pound yen. The areas to note, of course, is whether we can break this area to the downside around 188.26. or whether we will now continue to the upside and break above those recent lower highs. So definitely keep your eyes on pound yen. Bitcoin's next to note, which is slowly trending to the upside, and as a result is basically making new highs as we speak. That said, we do have that lack of momentum in comparison to what we saw when price did break those all-time highs. So, keep your eyes on Bitcoin. Very interesting indeed, as price is clearly finding some resistance around the $70,000 a Bitcoin mark. Next to talk about is gold, which is just continuing to the upside, continuing this bullish momentum to the upside, and is now far above those all-time highs back at 2150, and now prices at 2180. So very important levels on gold to note. Definitely keep your eyes on gold. Next to talk about though is oil, which is ranging between these areas of liquidity. So very interesting to note on oil. But of course, any conflicts within the Middle East or any news from the Middle East is greatly pushing oil one way or another. So a lot of volatility is certainly occurring on oil. So that's all to talk about in the charts though. Lastly to talk about, of course, is the economic calendar. We're getting lots of very important data this week. Not too much though, just the data that we are getting is very important. So listen out for this. Firstly, we're getting some inflation rate figures, so from the US and Germany. As well as that, we're getting the British unemployment rate figure, followed by some new Chinese yuan loans figures. As followed by that, we're getting the British GDP figure, followed by the US producer price inflation rate figure, followed by the US retail sales data and US consumer sentiment figure. So lots of data to note coming out this week, lots to listen out for. Lots in the articles, lots on the charts, and lots on the economic calendar. Hope you have a great trading week. But that's all from us at Wildwood Capital. Have a great one. See you later.